Hi class, a pleasant day to all of you. This is Sir Dan Dumantay. In this video, we are going to discuss the overview of costing and pricing in business operations. Let us again take a look on the goal of business, which is profit. So here we have learned from previous slide that the goal of business is to have an increasing trend of profit. And how do we compute profit? So for merchandising and manufacturing, this is the basic uh, presentation of in the calculation of profit. We have sales less cost of goods sold will give you your gross profit, less expenses will give you the net profit. Okay? For businesses, if we want to increase profit, we have to make sure that we are going to increase sales because sales is the revenue source of the business. And class sales is determined by the number of units sold, which is the quantity sold, multiply that with the selling price. So there are two variables for sales, the number of units sold and the selling price. And class, to make or to increase sales, we have to make sure that we can increase the number of units sold. Okay? However, how can we increase the units sold? We have to make sure that we have the proper selling price. We have the appropriate and competitive selling price. Okay? So, class, what will determine our selling price? Our selling price will be determined by the cost of goods sold. Okay? If we have a lower cost of goods sold, we will be able to have a lower selling price that can increase the number of units to be sold. Okay, class? So, the other variable also is the expense. To increase our profit, we have to make sure that we have reduced expenses, okay, so that our profit, the bottom line will increase, which is the net profit. Okay, class. So this is the overview of the calculation of profit in business. So, class, for this lesson, or I mean for this subject, we will be discussing more on the cost of goods sold, which is the costing. Let us take a look, class, of the overview of service business using the accounting equation. So, if we will put up a service business, we will have our assets, liabilities, and equity. We will have our current assets, and as we have discussed in basic accounting, the normal current assets or the standard current assets or the basic current assets are cash, accounts receivable, and then the contra account of accounts receivable, the prepaid rent, and supplies. And for non-current assets, we can have equipment and the contra account of the equipment for the depreciation, and then vehicle. These are only some of the non-current assets. We have learned that we have several non-current assets, which are building, furniture and fixtures, computer, and so on and so on. Okay. So plus we will use for illustration purposes, we will be using these assets. And for liabilities, we have learned current liabilities and non-current liabilities. And an example of current liabilities is accounts payable and then loans payable short term. We have learned that current liabilities are those liabilities that will be paid within 1 year. And non-current liabilities, these are liabilities that will be paid more than 1 year. And in our equity, we have the owner's capital and owner's drawing, the contra account of owner's capital. So if we will put up a business, we should have our capital, okay? Assuming that the business capital is 500,000, and if the owner thinks that 500,000 is not enough, then the owner can secure a loan from other sources or from financial institutions, from the bank. Okay, assuming that the owner will secure a loan of 150,000 from the bank. So in effect, 650,000 can be used in by the business, or can be used as startup for the business. So here, if these are all cash, then the business will have a cash of 650,000. Okay, and then of course you need to prepare for the operations, and in preparation you need to buy the necessary resources. So if you want to buy or in rent to a space for your office, assuming that you the rental is 40,000, so you will have your prepaid rent, and then if you want to purchase some supplies to start up the business and some non-current assets, like for example equipment and vehicle. So now these are the resources that you think you would need in the business, and then of course your cash will be reduced to 240,000 because of the purchases or the procurement of the things that you will be needing for the business. So, class, with this, you can probably start the business, but it is better that before starting the operations of the business, you will have to prepare your initial statement of financial position, which will reflect your initial assets, liabilities, and equity before starting the business. Okay? So you can prepare your initial statement of financial position. For your research, and if you will be asked to start up a business, then you can prepare the initial statement of financial position. Okay, class? And then now we can start doing the business. We can start our revenue and expenses because we already have our resources, assuming that we have expended a certain amount in the business. And then of course if we are in service business, we will have a service income. Okay, and then if we have expended 130,000, and then we will be able to generate a service income, assuming that the services that we have provided is amounting to, oh, by the way, if we have expended 130,000, take note that we will be using our cash for our expenses. So here, our cash will be reduced by 130,000. So it will become 110,000. Okay, so this is how it will look like. So if we have expended 130,000 to generate service income, and assuming that our service income is 140,000, and then this service income, we were able to get it from our customers, cash of 50,000, and our customer made a promise to pay 90,000 for a certain number of days, and then this will be our sales, 140,000. So with this, we will have an additional cash of 50,000. Take note, class, we will have an additional cash of 50,000, and then we will have accounts receivable of 90,000. Okay, so our cash now is 160,000, and we have a receivable now of 90,000. Okay, class? So with this, we can already prepare our income statement by presenting the revenue and expenses. So in this case, we have a service income of 140,000, which is our revenue. Then we will deduct the expenses. Then we will have a profit. In the basic accounting, you have already learned how to prepare income statement for service business, which is service income less expenses will give you your profit, okay, or loss if expense is higher. So class, we have also learned from basic accounting that revenue and expenses are nominal or temporary accounts which we have to close at the end of the year. So assuming that this is our operations for the whole year, we are going to close revenue and expense, and the difference will be added if it is profit to the owner's capital. If it is a net loss, it will be deducted from owner's capital. So in this case, there's a profit of 10,000. So it will be added to owner's capital and revenue and expense will be closed. So closing of revenue and expenses or the nominal accounts would make the balances of all these accounts zero so that in the next calendar year or reporting period, this revenue and expense will have a zero balance. Okay, so in this case, the 10,000 profit is already added to the owner's capital. And now you can prepare your statement of financial position at the end of the year. So make sure that your statement of financial position is balanced as far as assets should be equal with liabilities and equity. Okay, so that is the service business. Okay, class, I want you to recall first what we have learned from basic accounting. Now, class, we are going to have an overview. We will discuss the overview of merchandising and manufacturing. Okay, so this is our example. Okay, we have invested 650,000, and then we have already made certain procurement on the things that we will be needing for our operations. And now, from previous slide, our business is service. Now, assuming that our business is merchandising and manufacturing, then uh, how it will look like as far as the business operations is concerned. Since it is merchandising and manufacturing, we have to have our inventory, the items that we are going to sell because our revenue is selling. So we need to have the items that we are going to sell. And that is our inventory. Okay, we need to have an inventory. So if we will have an inventory, we need to either procure the inventory for merchandising business, we have to buy the inventory that we are going to sell, or we have to manufacture the inventory. Assuming that we have the cost of our inventory is 200,000, so now we will only have 40,000 from our cash. Okay, so these 200,000 are the units that we are going to sell. Okay, plus assuming that we have sold 180,000 out of the 200,000, so it means that we have a sales of 180,000. Okay, however, we have to add our profit from the cost of our inventory. For illustration purposes, we will just be using the markup. Okay, the basic way of establishing or determining your selling price. So we will be using the markup concept wherein we will add a certain percentage from the cost. If the cost is 180,000 and if we will be adding 40% for our markup, then our sales will be 252,000. So it means that the cost of our inventory is 180,000. Then we added a markup of 40%. So our sales is 252,000. Okay? So with this, assuming that out of the 252,000, we generated cash or our customers paid cash of 50,000 and the balance is a promise to be paid in a later period. So that is our accounts receivable. So with this, our cash will be uh, there will be an additional 50,000 in our cash and accounts receivable of 202,000. Okay? And since we have already sold this 180,000, we have to remove this from our inventory. So if we will remove that, then we will transfer that as the cost of goods sold, meaning the cost of this 180,000. So our cost of goods sold will now have 180,000, and the entry to record that will be we will debit the cost of goods sold of 180,000 and credit inventory of 180,000, meaning we are going to remove that inventory already because it was already sold. Okay, so now our inventory is only 20,000. So with this class, if you are going to add all your assets and then add the liabilities and equity, it should equal. Okay, provided that you would prepare your income statement, and then the accounts will be closed, and then the balance will be added to your equity. So let us do that. So here, you assuming, by the way, to complete the illustration, assuming that you have incurred 60,000 of your expenses. Okay, so here, class, there will be a reduction also of 60,000 because you have expended that. Okay, so here, um, if you have a sales of 252,000, okay, deduct your cost of goods sold, yung puhunan, okay? So 252,000 less your cost of goods sold will give you your gross profit of 72,000. Then less expenses of 60,000, then you will have your net profit of 12,000. Okay, class? So this is what will be presented in your income statement, your revenue and expenses. And then again, you will be closing this. So if you close that, the net profit will be added to your capital. Okay, class? So after the end of the year, you will now prepare your statement of financial position. Also, end of the year, you prepared your income statement. So that's why you were able to determine that your net profit is 12,000. So after that, you can now prepare your statement of financial position. So in preparing the financial position, oh, by the way, if you want your statement of owner's equity separated, then you can just present this equity and present only the balance. Okay? But for illustration purposes, we will just prepare the statement of financial position, meaning adding all your assets, and it should equal with your liabilities plus equity. So in this case, you only have cash of 30,000, and adding all of this, you will have 662,000. So which will balance with your liabilities and equity. Okay, class. This is an overview of the merchandising and manufacturing businesses which we have presented in the accounting equation. Okay, class? So, in summary, class, let us have an overview of income statements. So, for service business, you have your service revenue or service income. Less expenses will give you your net profit. For merchandising, you have your sales. Less cost of goods sold will give you. By the way, your cost of goods sold is the cost of the purchases that you have made for the items that you are going to sell. That will give you your gross profit, less expenses will give you your net profit. And for your manufacturing, you have your sales, then less cost of goods sold, and your cost of goods sold will consist of the direct materials, the direct labor plus factory overhead in producing or in the production of the units that you or the product that you are going to sell will give you your gross profit less expenses will give you your net profit. So class, this is just a snapshot of what you have learned from your basic accounting with regards to the preparation of income statement. Okay. So class, in the next module, we will be discussing the cost of goods sold. Okay? Okay, class, if you have questions, please let me know. Bye for now and have a great day.